Ladies and gentlemen, good day and welcome to the investor call of Cigniti Technologies Limited to discuss the Q4 FY23 results. Today we have with us from the management Mr. Srikanth Chakhilam, Chief Executive Officer, Mr. Krishnan Venkatachari, Chief Financial Officer, Mr. Vinay Rawat, Chief Revenue Officer, Mr. Raghuram Kovidi, Chief Delivery Officer, and Mr. Sairam Prabhu Vedam, Chief Marketing Officer, and Mr. Veera Reddy Patlola, Global Head of HR. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on the touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Smith Shah from Adfactors PR. Thank you, and over to you, sir.
Thank you, Zico. Good day, everyone. Before the call, we would like to point out that certain statements made in today's call may be forward-looking in nature, and the disclaimer to this effect has been included in the earnings presentation shared with you earlier. The call may contain forward-looking statements based on the currently held beliefs and assumptions of the management of the company, which are expressed in good faith and in their opinion reasonable. Forward-looking statements involve known and unknown risks, uncertainties, and other factors which may cause the actual results, financial conditions, performance, and achievements of the company or industry results to differ materially from the results, financial conditions, performance, or achievements expressed or implied in such forward-looking statements. The risk and uncertainties relating to these statements include, but are not limited to, risk of expansion plans, benefit from fluctuations in our earnings, our ability to manage growth and implemented strategies, competition in our business, including those factors which may affect our cost, advantage, wage increase in India, our ability to attract and retain highly skilled professionals, and our ability to win new contracts, changes in technology, availability of finance, our ability to successfully compete and integrate our expansion plans, liabilities, political instability, and general economic conditions affecting our industry. Unless otherwise indicated, the information contained herein is preliminary indicative and is based on the management information, current plans, and estimates. I would now like to hand over the call to Mr. Srikanth Chakhilam for the opening remarks. Thank you, and over to you, sir.
Good afternoon, everyone. I'm pleased to present you the results of our fourth quarter. Despite a challenging market environment, we've achieved a yearly growth of about 22.3% in dollar terms, which is a testament to the hard work and dedication of our team. We did experience a slight decline in our Q1Q growth, and this was largely due to some unforeseen ramp downs and budget cuts, which contributed to revenue flatlining. However, we are confident that we will see comebacks from Q2 and Q3 as we continue to focus on expanding our digital offerings and winning new logos. On a positive note, our EBITDA improved from Q1Q from 15% to about 16.1%, which demonstrates our commitment to the financial discipline and efficiency. We also have a good order book for the company, which is a strong indicator for our future growth potential. As we continue to expand our digital focus, we are putting in all efforts to offer digital-first solutions to our clients. We believe that this will enable us to stay ahead of the competition and also provide better value for our clients. In this regard, I'm also pleased to update you on the recent developments at Cigniti. We have, as you may be aware, we've inducted a new board member, Mr. Srini Kandina, to our team, who brings a wealth of experience and expertise into the digital space, which will be quite invaluable to us as we continue to grow our digital focus. We are confident that under his leadership and guidance, we will be able to stay ahead of the curve and provide even better value to our clients. We will remain committed to financial discipline and efficiency, and we will focus, and we are confident that our continued efforts will ensure sustainable growth for the company. I'm also pleased to announce that we will be giving a dividend of rupees 3 per share and also special dividend of 2.5 rupees to commemorate the completion of 25 years. We are grateful for your continued support and also look forward to your continued success in the future. I now hand over the call to Mr. Krishnan, our CFO.
Yeah. Thank you, Srikanth, and a warm welcome and good evening to the shareholders and members, and been a pleasant evening, and thank you all for joining. I think the year has been fantastic for us amidst all the global events, whether it is Ukraine war or whether it is European slowdown, and off late in the last quarter in terms of the last quarter plus in terms of the looking at the global economic situation driven by the US markets invariably. I think we have weathered the storm basically in terms of dollar terms. This year has been a growth which has taken us at about close to 23% as against 168 million or so. We have delivered at about 206 million with an efficiency in margin which was promised clearly that we will build in efficiencies across, while the EBITDA for the year stands at about 14.5% comparing to what it was at about 10.5% or so in the last year. I think by far the tremendous year. I think consecutively comparing to the previous year where the growth rate on dollar terms which was there at about close to 36% or so, I think we have marched ahead in terms of our growth. I think signaling very clearly that our sales strategy, our technology strategy has paved the way, and we are moving ahead in the right direction. Coming back to the business, I think I will have my colleagues to speak about the situation and the current scenarios, but I think by far the entire order book position, assuming with the current set of uncertainties with about 85% renewals coming through, is in the range of about close to 202 million, and we are confident that the year ahead, though we are not in the process of giving any guidance, we should be continuously improve our EBITDA margin and also grow in similar lines as to where we are and things like that. The year has seen a profitability increase in terms of a stability in terms of the resources, and there has been a price increase in more than 50% of the revenue build accounts, which has contributed marginally, and also the newer wins which has come from strategic accounts at a higher margin. While this being the case, I think we have by far reviewed on a constant basis regularly in terms of our manpower, and our utilization levels have gone to about close to 82% or so. Signifying very clearly, one is that there is a mix and match in terms of trying to get that built, and two is that we have also done on a periodical basis to let go based on performance parameters people so that we don't take a aftermath or the shock at the end of the year as to what we do for the size of the company where we are in. I think it's a continuous process, and we have also done a churning on the pyramid side. The offshore shift has happened to the tune of about close to a percentage point, which has also contributed to the margin, which has been our endeavor clearly on the managed services to get over more into the offshore and bring in predictability. While the top 20 accounts continue to contribute about close to 50%, and the newer revenues during the year have contributed about close to 7%. I think we are extremely happy to state that our nurturing and growing the accounts in terms of the strategy, coupled with our digital initiatives which are being taken up in terms of mining from the existing accounts as a digital transformation and service providing, is also taking shape. The total digital revenue comparing to 9 million what was last year, we have touched at about close to 18 million, close to in this current year on 206 million, and we have pegged this double-digit 200% growth for the next year in terms of the contribution what is coming through. That's the target where we are getting through. We also have our share of what we call the bad luck in terms of customers pushing down, ramping down on few of the unexpected areas in terms of the IT technology as a sector where our exposure is very less, but I think even on the few other sectors which we have carefully priced in, and still we have worked out strategies in such a way that making a double-digit growth should be a possible scenario as we stand today. Our dollar rates have inched marginally, and we are there hovering at about $74 plus in terms of the on-site, and my offshore rates have moved ahead to $24.4. And overall, the receivables and the collections, I think there's been a fantastic cash generation. I regret to inform, and there is a small typo error in the presentation, investor presentation which is carried out. I think the total cash and cash equivalents in the balance sheet is, and also the company investments in mutual funds put together is at about close to 302 crores, is what is the total number, and that figures are slightly interchanged, so net everything remains the same. And we have generated a free cash flow of 157 crores for the year after paying out for a dividend and after paying out for the acquisition of the company Opera Digital, which is about close to 25 crores. And we have also paid a dividend of about 7-8 crores, and we have paid buyback of shares with taxation of about 55 crores, in all put together about 85 to 90 crores. After that netting off, we have generated a cash flow of about close to 157 crores. Applying for the capex of nominal capex of 13 crores, we are left with about 144 crores, which is accumulated out into the investments. The receivable days stands at about 55 days, and the team has been doing a fantastic job in terms of the collection. Cost optimization has been order of the day. Q3 to Q4, again, we have come down on the costs, which is a global phenomena today. I think that will continue to be a continuous exercise as we start moving. Wherever there is optimization, we are trying to bring in. Overall, net, I think we are on a good wicket, and our integrations have been successfully completed, and the full-blown results will be felt in the coming quarters, and I'll have my business colleagues talk about the overall scenario in terms of the business and technology. With these few words, I thank everyone, and I'll be back again on the question session, but I think I'll hand over the mic to my colleagues and CRO of the company, Vinay Rawat. Over to you, Vinay.
Thanks, Krishnan. Good afternoon to everyone. I think Srikanth and Krishnan have already spoken about our last quarter. Krishnan also touched on our overall sales strategy, which instituted last year, and I'm glad to inform that the strategy actually has been working in terms of growing our existing accounts. Our new accounts strategy, has yielded industry standard results, and we are actually making few changes, which we believe will actually lead better results in the coming financial year. Coming to the customer's outlook, the only thing which actually we have seen is, specifically last quarters, the customers actually have become, or rather have taken a precautionary approach, where they are much more careful in terms of doing the discretionary spend. However, we haven't seen any drastic cuts or any sort of panic in their overall spend, which makes us believe that whatever few ramp downs which actually we saw last quarter with few of our customers, some of them actually will come back either in next few months, and we expect that going forward, I think our overall, given that we have a pretty strong order book, our revenue outlook should also be remaining pretty healthy. I think that's pretty much it from my side right now, and actually send it over to Raghu to specifically talk about customer satisfaction. Raghu, over to you.
Okay, thanks, Vinay. Good afternoon all. I think all my colleagues have covered the overarching strategy and business scenario thus far. From a client's perspective, we have seen one of the best results in our client satisfaction scores, standing at about 3.87 out of 4, with superior coverage in terms of response. This is an important score to us because it means a lot in terms of the value of delivery that we conduct on a daily basis to our clients. We continue to see increased demand of digital services, and we continue to ramp up on the digital capability. In the last call, we did speak about our strategy of increasing our digital footprint as a company. So we continue to do a great job there, and we continue to grow that piece of business significantly. And overarchingly, from a technology standpoint, we continue to invest into innovation relating to all the latest technologies, disruptive, AI, ML, and low code, no code, and stuff like that. So that continues to resonate with our clients as we expand the services footprint in each of our existing accounts. As Vinay alluded to, focus has been to increase the wallet share in existing accounts, and our clients have been extremely receptive to our increased capability, and we will continue to see success in this area. With that, I think from a overarching technology standpoint, we are focused on the right areas. As Vinay said, we are fine-tuning our NN strategy to see how we can fare better there, and we will continue to scale capability and presence globally in terms of headcount. Our utilization, our gross margins, our unutilized costs, all those metrics have done extremely well over the last few quarters. With that, Krishnan, I'll hand it over to you.
Yeah, thank you, Raghu, and thank you, Vinay. And I request now Sairam Vedan, our Chief Marketing Officer, to talk about the marketing strategy and the updates.
Yeah. Good afternoon, good evening. Thanks, Krishnan, Vinay, and Raghu. As our executive team alluded, we are putting our head down to focus and ensure we always put the client's interest at the center. But I'm extremely glad to update a few seminal recognitions that reinforces the pivotal brand strategy at the center of everything that we do. ISG recognized us as a contenders in digital medtech services that includes medtech digital transformation, pharmacovigilance, regulatory affairs quadrant, which is our vertical enforcement, going back to the energy utilities recognition that we got earlier. We are also recognized in the manufacturing supply chain digital transformation. That's one set of accolades. More importantly, market positioning. I'm very happy to also announce that IDC, for first time in Cigniti's history, we've been put up in the operational digital engineering landscape, which again strengthens our pivot to its equality-first digital engineering move that we are doing. Third and foremost, Zinnov, another leading firm, positioned Cigniti for our intelligent automation services in the mid-tier service provider segment across RPA, intelligent automation for banking, financial services, retail, manufacturing as breakout providers. So that sort of summarizes a stellar positioning strategy that is tying together what our on-field sales and innovation delivery alluded to. That's pretty much it, and the digital engineering recognition is a trend in the direction, and we are expecting some significant call-outs as we move forward. Before I end, what we're also seeing is, I just wanted to give this note, so Gartner revised its IT services spend note actually to 9.1% in 2023. This is as of April 2023, which is a revised, market outlook up from 5.5%. It is actually a 3.6% more that Gartner is predicting. Definitely there are headwinds and cautious note that we are all looking, but we believe that certain key verticals where we are also playing well are expected to show significant resilience. Healthcare by 5 to 6%, travel and transportation by 6 to 7%. These are from the NASSCOM McKinsey report from Global 2000 vertical spend, and I'm only calling out the key verticals, and incidentally Cigniti played strong there, including energy utility, which is expected to grow by 11 to 12% from the McKinsey report. So we are here to answer any more questions. I'm giving it back to Krishnan.
Yeah, thank you, Sai, for the brief note. And I now hand over the mic to Veera, who is our global HR head. And Veera, over to you.
Thanks, Krishnan. Good evening, everyone. We had a great last year, which resulted in increase of our overall headcount by around 400 people, with majority of these additions being freshers. So post-pandemic, if you see across the industry, attrition has been a big concern, especially in the IT industry. However, over the last 6 months, we have seen that stabilizing. At Cigniti, we are running below 20% now, and we are very soon expecting it to go to pre-COVID levels. As our CFO covered, we are not looking at any ramp downs as we have a robust continuous performance evaluation mechanism, which helps in manpower optimization from time to time. We've also planned salary revisions this year to cater to the rising inflation, and the same will be closed this month. So last year, we've been recognized as a great place to work by Great Place to Work Institute, and this is a testimony to our employee-friendly culture and leadership credibility. In our effort to continuously improve this year, we'll be focusing on DEI, L&D, apart from the other engagement activities that we have been doing. Hopefully, we'll get better by day and truly live up to the standards of a great place to work. That's all the update from my side. Thank you very much. Over to you, Krishna.
Yeah, thank you, Veera. I think we'll now move on to the question and answer session. Ashish, you can take it up.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Mr. Raj from Arjav Partners. Please go ahead.
Hello, am I audible?
Yeah, very much, Mr. Raj. Please go ahead.
Wanted to know your outlook for the FY24.
In terms of the business outlook, yeah. So
Overall outlook.
Overall outlook, yes. Overall outlook I give probably on the economic environment as to what the business is, probably my colleague Vinay will speak. I think the overall outlook, we are confident with the current set of order book and the renewals at about 85%, as I told you. I think the numbers in terms of, though we don't provide any guidance, but we are confident of.
Hello. I can't hear you. Hello.
Yeah. Yes. You are able to hear me? Hello.
Hello.
Yeah, gentlemen, we are able to hear you. You are able to hear me?
Yeah. Now I'm able to hear you. Yeah. Go on.
Now, overall, the scenario in terms of the performance for the next year, though we don't provide any guidance, but I think we are confident that the current quarter performance could be repeated out very clearly, and we should be able to grow over the last average of over the last 2 years what has been done. That is a confidence level at which we are moving ahead, because looking at the order book and the renewals at about 85%, and the likely expectation is the market is expected to revert back somewhere around August, September or so. But if in terms of any specific question to the economic environment in the US or anything specific, probably some of my colleagues can answer if you have anything specific.
No. I think regarding AlphaStreet, will you be able to protect your EBITDA and everything?
Overall, for the year, please don't look at the quarter in isolation. You look at the whole year in isolation. In entirety, we have done at about 14.5% EBITDA.
14.5% EBITDA, yes.
So we are confident of improving this and not to decrease.
Okay.
We completed last year also from 10.4%, we made it to 14.5%. And on a neutralized basis, I would like to make it clear is that last time I had some one-off expenses, which we were there at about 12.5%, and it to 14.5%. Yeah.
Understood. So, looking at the commentary, we can assume that from our, from FY22, your growth in FY23, a similar thing can be there in FY24 also, right?
But you will also have to keep in mind on 2 counts, basically, because when there has been a push in the market, while we are confident on the growth to move up, you can't expect a 400 basis point improvement in the EBITDA. What is there at 14.5%? We expect about 100 to 150 basis point improvement in EBITDA.
Okay. All right. Okay, sir. Thanks. Have a good day. Bye.
Thank you. Before we take the next question, a reminder to all participants that you may press star and 1 to ask a question. Our next question is from the line of Mr. Pankaj Kumar from Alpha Cap. Please go ahead.
Hello, sir. Congrats for a good set of numbers. Sir, my first question, sir, would be on the wage hike. So you were saying that we will be taking a wage hike in April. So has that been taken, and how much is that, sir?
The wage hike has not yet been implemented. It is effective in April. It will be implemented. and it's a split between offshore and on-site. The offshore could range anywhere between 10 to 12%, and on-site could be around anywhere ranging between 2 to 4%.
Okay, sir. And sir, in your initial commentary, you said that we have seen some ramp downs in Q4, and that is why flat QOQ revenue, and we are saying that improvement would be from the second quarter. So it's like first quarter is like weak, and then things will improve from the second quarter, or how are we thinking that?
No, exactly. This is a justification to be given basically for a flat quarter between Q3 to Q4. Q3 to Q4, the flat quarter in terms of the breakup, if you look at it, is that there has been some amount of ramp down, which has contributed close to about $900,000, and then about $400K of discounts which we have been negotiating and need to be provided basically, which is relating to the previous period. But where it was allowed us, we were negotiating for a service credit. I think that needs to be due to a change in DMO office. We need to provide that out very clearly. So these are the two instances which would have neutralized. I think we would have been definitely on a trajectory of growth. But I think if you look at it, the unplanned reduction which has crept in and which has already been considered in my 85% renewal is already 15%. I knocked off on the unplanned reduction ramp down. So probably if you look at mostly as a Q1, Q2, Q3, Q4, we expect sequentially to grow very clearly. There's no shaking start to the quarter basically. We expect sequentially to grow, but these are normal part of the business, and that's the reason I have priced in so that 85% of my renewals, with the delta coming through based on the pipeline available in terms of pressing the engagement in terms of the probability of conversion.
Yeah. Sure, sir. And sir, on the order book side, you are saying 202 million right now, but in the last quarter, I think you were talking about 210 million for the next year, executable for FY23.
Absolutely, you're right. That's the reason I told you that when I priced in a higher percentage in terms of the renewal, considering the market now, though we are expecting that around by Q2 time, probably all this should taper out. Still, as a conservative estimate, we need to work through very clearly, and that is the reason I priced it about 85%. And I've also moved ahead on a cautious approach to push with the sales and the delivery team to really get the delta in terms of the differentials out, where we can start working at the beginning of the year rather than coming and looking at it at the time of ramp down which is happening. So we have provided enough cushion over that, and we are trying to be transparent.
Great to know that, sir. And sir, on the previous question, you said that margin we can expect improvement of 100, 150 basis points. So that would mean that Q4 to kind of sustain for the next year.
Probably you can look at it that way, Q4 to sustain for the next year, but probably there will be oscillations between Q1 to Q2, Q3 to Q4, the way the current year has ramped up if you look at it, because it's obvious that we will be providing some salary revisions, and there could be, we are gauging the economy and what is happening. We are trying to get through to the optimization. I think there will be a small variations coming through within the quarter, but I think overall we expect this to sustain.
Sure, sir. I'll join back the question. Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Our next question is from the line of Naisar Parikh from Native Capital. Please go ahead.
Yeah, hi. Thanks for the important. So, the first question was that, can you do a split of your revenue for this year, full year between, say, digital application services and things like that? Like, what are the key sub-segments and how should we look at it?
Oh, yeah. So we always, please go ahead. Yeah, I think, the way industry categorizes digital services, so a lot of work which we actually traditionally have been doing, even in our core services, actually falls into digital services. I think when Krishnan actually gave his commentary earlier, when he was referring to digital engineering services, which was about 8% of our overall revenue in last year. But if you look at the digital services which we do or which we provide to our customers, it is closer to about 30%. Is that right? Yeah, absolutely. It's closer to about 30% of our overall revenue.
Right. And what is the rest? Is there business? Is there BPO, BPM? Is there some application service? Is there testing? Can you give some broad bifurcation?
So we don't do BPO, BPM. I'll just give you an example. Like we do a lot of data migration and data migration from on-prem to cloud, and anything around data assurance. And any application when actually moves out from on-prem to cloud, anything around that application during that process, that assurance is actually we do that. In addition to that, of course, there are native application development, there are mobile web applications, of course, cloud native applications like Salesforce or ServiceNow or NetSuite, those kind of applications which needs any sort of customization. So those are the kind of things actually which we provide digital assurance around them, and that's what actually I'm categorizing as digital services. In addition to that, we also help customers to not only implement the entire DevOps, DevSecOps pipeline, but also automate them, do data engineering, data analysis, provide AI ML services, which is what is being categorized as digital engineering services. I hope I answered your question.
Yeah, got it. No, I was trying to understand the remaining. So I understand the digital engineering, which is 8%, and your digital services assurance, which is 13%. What is the remaining,
So the remaining services are around QA, QE, including automation. We do a substantial part of performance management, test automation, functional and performance testing. That's actually is the balance services into that 70%, which actually you're asking for.
Understood. Got it. And from a margin perspective, can you give a sense of what would be the margins in your digital engineering versus digital services and this? Is there some, what is the kind of delta, especially given that you would be growing your digital engineering and digital services faster? So just from a margin perspective or billing rate perspective, what is the kind of delta between the two?
As it stands, basically, we are trying to make it slightly better. As it stands, basically, there is the blended rate basically translated about close to a $6 variant in terms of what we are at on the quality engineering to the digital side, basically.
Yeah, in terms of percentage, digital services actually drive close to about 10 to 15% higher realization as compared to the QA, QE services.
Got it. So it's around 10-15% higher. The 40% is around 10-15% higher than the 70% of QA, QE, right?
That's right.
And after the wage hikes that you are going to do and the order book that you have of $200 million, the billing rate on that order book, does that bake in the wage hike that we are doing, or that wage, we need to take further price increases to compensate for the wage hike which will be implemented from this April?
The current market is such that we won't be able to really go ahead and push for a rate increase with the customers. The current market is very clearly get that renewal done. If possible for mining, which is possible. What we are trying to do is a combination of factors, basically. The newer wins on the digital side will offset as one of the areas. The second thing is that we also have gone for certain cost optimization measures, which will also offset. And these are the two aspects, basically, which should take us through.
Right, but just like for like at the gross margin level, fair to assume will be at least 8-10% lower on the current order book, and then obviously we need to use the utilization other measures to bring it up. Is that fair?
Yeah, it's fair basically because of the continuous exercise, and we have mastered it this year, and we have mastered it earlier in the past way, but this year has been a full-blown year where we have done it beautifully. I think we are confident of further improving it.
Got it. And just one last question. In terms of your, obviously the climate is not very good, but just in terms of your new client wins and, even to maintain a 10-15% growth, what is the kind of pipeline that you have today? And, are there any large customers, especially $1 million plus customers, that you are targeting and, which you expect that there could be scope for increasing revenue share from there?
Absolutely. So I alluded to in my commentary that the sales strategy which actually we started implementing last year, was predominantly to increase our market share or wallet share in our existing customers. Our endeavor is that our minimum customer size where we spend sales bandwidth should be $1 million. And we have made a significant progress in last 1 year, and we are reasonably confident that we will continue to make progress over there and make an average size of a customer where we are spending our sales bandwidth to be about $1 million. As far as the new business is concerned, we actually have a good, healthy pipeline. We have certain deals in play right now as we speak, where the decisions are actually expected in the next couple of months. We continue to actually implement new channels to generate connects with the new customers, which is what in fact I was mentioning in my earlier commentary that we are implementing new strategies to bring in new customers, new connects, new leads in our pipeline, which will actually help us generate new business closer to it, somewhere 8 to 10% of our total yearly plan.
And currently your $1 million clients are how many?
Yeah. I don't have it off the line there. Yeah, there are totally about close to 43 clients in terms of $1 million plus.
Got it. Okay, got it. Thank you so much and all the best.
Yeah, thank you.
Thank you. Our next question is from the line of Abhishek Sharda from Hem Securities. Please go ahead.
Yeah, hello. Hi, sir. Congratulations for great set of numbers, and thank you for giving me the opportunity. So, sir, first thing I want to ask, can you share what is the attrition rate, current attrition rate, and what is your view on it going forward?
Veera, you would like to take this question?
Yeah. So last year we ended at 20% annualized attrition, and currently as we speak, April trending at below 19%. We are also looking at going below 15% through the year. So hopefully we will continue at that.
So you are saying in FY24 we can see around 16%. Is the understanding correct, sir?
15 to 16% is what we are anticipating.
And so one more thing I want to ask, we have ended this year at 14.5% EBITDA margins, and we are expecting 100-150 basis points improvement. So, is this 15.5% EBITDA margins or 16% EBITDA margins are sustainable?
Yes.
Or I mean, there is more scope of improvement in this.
So this is sustainable. More is merrier, right? There's always scope for more because we'll endeavor to get more. But I think in terms of sustainability, I think the baseline we will definitely sustain slightly better than this.
Fine, sir. And sir, one more thing, globally BFSI space is going through basically a challenging time. So what is our view on this space, and are we facing any challenges in some delaying of deals or something like that in this space?
So while BFSI actually happens to be our largest market segment, but the clients which we have been dealing with, they have been pretty stable. And our business with our BFSI clients last quarter and also for foreseeable time period which we actually have this quarter or next quarter looks to be pretty stable. The banks which we deal with or the institutions which we deal with, they are fairly stable organizations. They don't have, at least on the surface of it, it doesn't seem to be that they are under any sort of risk of what happened with a few banks in the U.S. market. In fact, we do expect that resulting out of this, there could be an opportunity for consolidation and depending upon how are we placed, we could be beneficiary of that. So that's pretty much I can share as of now.
Fine, sir. And sir, lastly, one more question. Like, we have been consistently able to improve our EBITDA margins from last 4-5 quarters. So can you share from which vertical we are getting this improvement? Mostly from which vertical? Business vertical.
Yeah, the business vertical in terms of travel has yielded slightly. On the healthcare sector, which is especially where we are working on the medical devices sector, I think these are the two sectors which are contributing.
So travel and healthcare are the major sectors from which we are getting improvement in margins, right? Yeah. Thank you for such a good responses, sir. Thank you.
Thank you.
Thank you. Our next question is from the line of Hiten Boricha from Sequent Investments. Please go ahead.
Hello.
Yes, good evening.
Yeah. Thank you for the opportunity, sir. Very good evening. Firstly, I want clarification, sir. On slide number 4, you have mentioned the number of client as on Q4 is 230 and as on full year FY23 301. So just want to understand what's the current number of client. Is it 300 or 230?
Yeah, there are two things which you have to look through. That 230 clients live as of Q4. Total service clients will come as 301 because some clients get serviced and moved out. So as of now, the live service client as of Q4 is 230.
Okay. Understood. Okay. So my first question is on the outlook, sir. So we have done a very good revenue growth of around 30-32% this year. But based on your commentary, starting commentary, which you mentioned, we have seen sort of slowdown in the Q4. So is it understanding correct that the revenue growth will be somewhere between 15 to 20% considering the slowdown with the growth in the US market, especially in the banking sector, will take at least 2 to 3 quarters from here? Just wanted to understand on that side.
Yeah, actually, we do not provide any guidance in terms of numbers. That has been the practice over the last 5 years in terms of not providing any guidance. But I think we have talked about in terms of, I've given the data as much as possible in terms of the order book and in terms of the confidence of where we are and things like that. So, the market is market where we are, but I think as a mid-cap segment, probably yes, and the size at which we are in, we are pulling all our strengths today. But I think we will not be able to give any guidance, but I think we'll be able to conclude to say that the confidence and optimism is quite high.
So let me take it the other way. Somehow this slowdown in the BFS sector, especially in the US, is it impacting our growth CAGR for next 2-3 years? What's your visibility on that? I just want to understand, is it impacting the growth? So we were doing a very good growth in last couple of years. So is that the pace has came down because of this?
I think so I just mentioned earlier, earlier gentleman actually asked a similar question where I did mention that customers which we have in our portfolio, they are fairly stable. We don't see any risk with respect to their business in the sense like there's no indication. It's not only based on what we actually have read in the media or press, but also from our customers. They're fairly stable organizations and stable institutions. So that is one part. The second part, with regard to our business with them, that has been fairly stable throughout the last quarter. And our customers actually have indicated to us that this outlook for that business is fairly stable. So going back, we are not getting any indication from our customers with regard to our business or with regard to their own business that there is any risk as of now. But as you know, things can change. But we're just sharing with you what is the visibility today.
Okay. Thank you, sir. Just the last question, sir, on the headcount. We have added up to somewhere around 400 employees this year. So can you give what kind of number we are looking to add this year also? Are we looking to add some?
It is a linear business. So invariably, if my business has to grow, basically the additions have to happen. I don't have I can't say that I have a non-linear revenue which is 20%, 30% bulk. Hardly my non-linear revenue could be on the consulting side, which is coming at about close to 2%. So invariably, it will be pro rata in terms of depending on the growth which has to come through.
Okay. That's all from my side. Thank you for your explanation.
Thank you. Our next question is from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. So can you please indicate on the revenue growth for FY24?
The revenue growth for FY24, as a principle, probably we don't give any guidance. We have also already expressed the higher level of optimism.
Okay. So what is the order book as of now?
About 202 million.
Okay. Oh, thank you.
Thank you. Our next question is from the line of Mr. Pankaj Kumar from AlphaCap. But before we go ahead and take that question, I'd like to have a reminder for all participants. If you wish to ask a question, you may press star and 1. Mr. Pankaj Kumar, you can proceed.
Yeah, thank you for the follow-up, sir. Sir, this question on number of clients, so 230 number of clients, this is lower than all the rest of the quarters. So any constant strategy we are doing that we want to improve client revenue per client, so we're reducing number of clients, or how we should be thinking on that side?
Yeah, so going back to what I was mentioning earlier, that our sales strategy is to increase our wallet share with our customers and provide them better attention, more focus, and provide more services to them. That obviously helps us to kind of deepen our relationship at various levels and be a contestant to get more business for them. So our intent is to actually deepen that relationship further and continue to make our average size of the account more than $1 million. In fact, if you really see, which I think Christian mentioned, that top 20 clients, our top 20 clients actually contribute almost 50% of our revenue. And if you actually take, even further, like top 50 customers, they almost contribute 80% of our revenue. So from a overall perspective, our strategy will remain to actually go after new customers who will become substantial customers for us and continue to service them with more agility, more focus, more attention.
Sure, sir. And sir, one last question on the consolidated balance sheet. So we can see that there is an intangible asset also out there now, and goodwill has also increased. So any comment on that? Because I think earlier also we had some exceptional items some couple of years back.
That is on account of acquisition of Apara and accounting thereof, basically.
So both these intangibles as well as goodwill is on account of that acquisition?
What is paid as a money is split in terms of they've taken our assets, the differential goodwill, and the differential is that the customer relationship is maintained, is valued as per the accounting standards, and that is treated in intangible and written off over a period, especially over a period of 3 years or 4 years or so. So that is the reason that intangible is.
That will be written off over a period of couple of 4 years.
Absolutely.
Sure, sir. Thank you and all the best.
Yeah.
Thank you. A reminder to all participants, if you wish to ask a question, you may press star and 1 on your touchtone telephone. Our next question is from the line of Mr. Keshav Garg from Counter EMS. Please go ahead.
So thank you very much for providing me this opportunity and many congratulations for good results. Sir, I wanted to understand that last year we did a share buyback, and sir, now also we are sitting on decent net cash surplus, and 1 year is about to pass since last buyback. So any plans on another share buyback?
I think the 12 month gap between one buyback and other buyback elapsed somewhere around in July or so. And definitely board, when they take an appropriate decision, we will definitely come back in the form.
Sure, sir. Sir, also wanted to understand that this quarter, fourth quarter, there has been a marginal decline in our top line, but the employee expense has also come down marginally. But sir, I understand that last call you mentioned that from 1st April we are looking at wage hikes for our employees. Sir, so now going forward in the first quarter, sir, if our top line remains stable at this level, whereas the employee expenses go up, then are we expecting a hit on margin from first quarter onwards?
See, it's always a phenomenon if you look through basically is that endeavor is always to grow sequentially. Leaving all that aside, basically, the continuous optimization is happening on the wage cost. That is what you have seen the reduction. While the appraisals take place, the appraisals also basically will have an effect spread over 4 quarters, which is also in line with the revenue growth which has come through. And the current quarter, I already made in my opening remarks, the rationalized EBITDA is there to assume at about 15.5% for the current quarter, while we had certain reversals to take it to 16% or so. So I don't see a big challenge, but we should look at year as a whole rather than looking at quarter as a period. There could be a small variations in the quarter, but I think which is a natural phenomenon. But if you look through for the year as a whole, we are confident of increasing by about 150 days.
Okay. So that is very heartening to know. And sir, lastly, sir, with the stress, especially on the IT side globally, so are we anywhere nearer to our acquisition target? Have we found anything or are we near that?
We will have to see. Our job is to review the proposals, but I think we will come back to the market as and when the board decides. But the intent is very clear that we would like to move ahead on the inorganic side, and we will definitely, when it culminates, automatically the active consideration what we are doing in terms of culmination probably will come back.
Okay, sir. Thank you very much and best of luck.
Thank you.
Thank you. Our next question is from the line of Utkarsh Somaya, individual investor. Please go ahead.
Thank you for the opportunity. If I were to look at your results, it's significantly better than the rest of the IT services sector. So just wanted to understand what differs your company from a typical IT services company?
Okay. I think there are a few factors. One, most customers over the years actually are looking for niche players with very deep competency into certain specific areas. As you know, we are fairly well known, not only into advisor and analyst community, but also to the customers, especially into digital assurance, QA, QE space. That specific positioning actually differentiates us as compared to any other providers or let me put it this way, that large providers who actually do everything under the sun. That's one part. The second part, our size actually makes us fairly agile, fairly responsive, and be able to provide attention and focus, which actually most of these customers are looking for. The third thing, which is actually helping us to gain market share into digital services, is our existing relationship with the customers, where we have been able to do a fairly good job of execution. And as a result of that confidence and trust, customers actually are trusting us on the digital services side as well. The last thing is our engagements with the customers actually have been fairly long term, and where going back to the same thing that I was telling, like our execution has been fairly stable, consistent. So customers actually trust us a lot. All these things put together, it has given us momentum, which has not gone down as compared to some of the peers in the industry. I think that's what I would say. But predominantly, our niche positioning is what actually helps us to differentiate in the market.
So most of what you just mentioned goes to say that you're very efficient at what you do, but I was looking for an answer in terms of understanding what your specialty lies in terms of any specific sector, or is there any barrier to entry in terms of skill set that you possess that your clients don't?
Yeah. I will add in few points to what Vinay said. This is Sairam. There are three buckets here, right? So one is this unique approach to having a specialized quality first, quality engineering, digital assurance capabilities that puts the quality of the software as a central dialogue that we have with our customers, which is which is an all-season thing because they have only one window to get their software right. That's a very niche capability, which also means that very specific competencies in that space is something that we bring uniquely. The second thing is this combination of a quality-first approach to specific capabilities of digital engineering that we are now bringing in makes us a very unique proposition, which in case you heard about the analyst commentary that I read at the beginning, some of the new recognitions that we got with specific positioning, be it from the IDC or from ISG or from the Zinnov reports, further calibrates that. The last point is the end customer inquiry indices, which we have reports from Gartner, shows that more than 23 global 2000 companies came in for very specific combinations that we as a service provider offer, which summarizes all that Vinay said, and hence we have a very niche, unique offering, which seems to be definitely resonating and which we believe is important as clients increasingly three important things: assurance, automation, and acceleration. That's what we provide.
Okay. And in which sector do you specialize in, and who are the players you compete with in the marketplace?
Let me answer it in two segments. Our strengths, we've been a cross-vertical player fundamentally because software quality is a cross-vertical dialogue. But that said, today, our key verticals are naturally, in terms of revenue split, banking, financial service, but we have been a very strong travel transportation provider, which we are now seeing significant resurgence. And alluding to what I said at the beginning of the commentary, our competencies in sub-segment of healthcare, that is the medtech, which is a high-spend vertical, even from the McKinsey report, that's another area, and we are also traditionally very strong in retail as a vertical. These are our top four verticals, and conjoined to that are recognitions in health tech and energy utilities, which is actually going to see 11 to 12% growth. We are already a recognized provider in that. So that's from our vertical play. But essentially, software quality is a cross-vertical play even now, because every vertical which invests in software needs quality to be deterministic.
Okay. And just one last question. When you have a dialogue with clients, are they more willing to spend on growth in terms of their internal business, or the tech spends are more towards cost cutting?
I'll first let Vinay answer that, and I'll give a market.
And has that changed in the past 1 year in the market slowdown period? Yeah, that's all from my side. Thank you.
Yeah, so as I shared earlier, we haven't seen any significant cuts as far as the budgets are concerned from the customer's perspective. It is more repurposing the existing spend. I think the major trend change, if I were to actually put my finger on, is discretionary spend. Discretionary spend used to be fairly common across different industry segments and organizations during pandemic, where digital transformation, organizations were spending millions of dollars in that. That is something which actually has come down, and customers actually have become pretty cautious in terms of doing any discretionary spend. That's one particularly what we have noticed as far as our customer portfolio is concerned. On the market trend, Sairam, you want to?
Yeah, I think Vinay covered the two things, right? So customers are today postponing short projects, but which are keeping the lights on, which is automation at the center of it. In fact, a research by Gartner emphasizes that Global 2000 company CFOs are only approving budgets which have only a shorter turnaround times of 18 to 24 months, but about 65% of them are investing onto digital-led automation. That pretty much summarizes what we as a value provider offer to the market with only one articulation: how can automation accelerate digital initiatives? In that sense, it is a good place to be in as long as we execute well, which our delivery teams are superb.
Understood. If you can allow me one more question, give a big picture view of the whole cloud transformation journey which started a few years ago. Where do you think we are in this entire journey? Have we just begun? Is this just a slowdown in the long-term journey, or just trying to understand the longer-term picture? Maybe a 5-year view, 10-year view.
So I think, I'm sure you've seen the results from Microsoft and Amazon. And, clearly the spend on the cloud transformation is actually kind of flattening. Most organizations, or rather most large organizations actually have already chosen their cloud platform. They have substantially moved their infra applications data onto the cloud. So while I think the overall transformation and the cloud spend is here to stay, but the speed at which the money was being spent over the last 3 years actually has flattened. And unless there are new applications or new areas which actually drive the cloud consumption, as of now, the visibility is that these things for the foreseeable future actually will remain flat.
And just add to what Vinay said, in McKinsey report, right, which is very specific to service providers, Indian service providers, global one, it actually throws in a new dimension. There is a concept called cloud governance and cloud rationalization, which is a big opportunity because, as Vinay rightly said, a lot of dollars have gone in to buy hyperscalers. But service providers will see high growth coming from data analytics on cloud, is likely to grow about 12 to 15%. That's where I think the cloud migration assurance. So there are some sub-segments of the post-cloud transformation aspects for the next 3 years, which will be a good opportunity play for specific providers like us. So it's more about cloud rationalization now.
Yeah, I think multiple organizations actually have published this, that for service providers, the biggest opportunity which will now will be in the areas of optimization and governance, basically helping the customers to consume what they have bought most optimally.
Understood. Thank you so much. Very helpful.
Thank you. Ladies and gentlemen, that was the last question for today's conference. I now hand the conference over to Mr. Srikant Chakradam for closing comments.
Thank you everyone for your time. We look forward for the participation in the next one, and look forward for the continued support, and we intend to do our best to all the stakeholders. Thank you.
Thank you. This concludes today's teleconference. You may disconnect your lines at this time. Thank you for your participation.